Another big week of finance and property news, so we pick over the bones and try to make sense of what's going on. And we ask, were the regulators asleep at the wheel? Welcome to the Property Imperative Weekly to the 28th of October 2017. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. We start this week's review with a look at the latest economic data. The latest GDP read from the US at 3.1% annualised in Q2 and 3% in Q3 provides more support to the view that the Fed will lift their benchmark rate before the end of the year. This is likely to have a flow-on effect by lifting rates in the international capital markets, which will mean higher bank funding costs here, as well as putting downward pressure on the toppy stock markets around the world. To confirm this view, we saw the benchmark 10-year Treasury bond yield in the USA rise to its highest rate in several months. In Australia, the ABS said the CPI was 0.6% in the September quarter, following a rise of 0.2% in June. The most significant price rises were electricity up 8.9%, tobacco 4.1%, and travel and accommodation at 4.1%. And also new dwellings purchased by owner-occupiers were up 0.8%. These rises were partially offset by falls in vegetables at down 10.9%, automotive fuel down 2.3%, and telecommunications down 1.5%. So the CPI rose 1.8% through the year to September quarter 2017, having increased to 1.9% in the June quarter, both below the RBA's 2 to 3% target band. The RBA's Guy Debelle spoke about some of the uncertainties in taking the economic temperature in Australia. He homed in on the CPI data from the ABS, making the point that our belated quarterly CPI reports are out of kilter with the monthly data now provided by many other Western countries. And in addition, the ABS will be revising their expenditure weightings in the CPI series, which means that CPI may currently be overstated by perhaps 0.25%. These revisions are currently made every 5 or 6 years, although there are plans afoot to make them more frequently. The ABS is under tremendous funding pressure, and there are risks their critical data series may be compromised. The national accounts data from the ABS for the year 2016-17 really brought home how much of the growth in the economy was thanks to household consumption, as opposed to business or government investment. This helps to explain why the RBA was willing to let household debt escalate to their current level, and why rates are so low, and why the property sector is so important to the overall economy. In summary, overall growth was 2%, the lowest since 2008-9. Wages rose 2.1%, the weakest since 1991-2. Growth in household expenditure as measured in current price terms was 3%, the lowest on record. The household saving ratio is at its lowest point at 4.6% in 9 years, and yet household consumption was the strongest growth driver at 1.22 percentage points. This was because households borrowed an additional $990 billion over the past 10 years, mainly in mortgages. The value of land and dwellings owned by households increased by $2.9 trillion over the same period and increased by $621 billion in the last year. And despite slow wage growth, household gross disposable income plus other changes in real net wealth increased $246 billion or 32.6% last year, largely due to a $3.6 billion appreciation in the value of land held by households. But of course, such high debt and high property prices are now creating fault lines in the property market and in household finances. We are seeing more risk in the property investment sector. Traditionally, in the Australian context, loans to property investors have tended to perform better than loans to owner-occupiers. This is because investors receive rental income streams to help pay for the mortgage costs. They're willing to carry the costs of the property against future capital gains, and many will be able to offset costs against tax, especially when negatively geared. In addition, occupancy rates in most states have been stellar, but things are changing as the cost of borrowing for investment purposes have risen, thanks to the bank's out-of-cycle rises, while rental returns are flat or falling, and the cost of managing the property are rising. In addition, the supply of investment property is rising and occupancy rates are declining in a number of key markets. As a result, more investors are seeing net rental yields after mortgage repayments and other costs drifting into negative territory, especially in Victoria and New South Wales. Our core market model and recent data from ANZ suggests defaults from the property investment sector are now running at similar levels to owner-occupied borrowers and are set to rise further. In fact, the ANZ full-year result, which superficially looks strong, up 18% on the prior comparable period, contained a number of negative trends as they focus more on the retail business in Australia and New Zealand. Yes, they have a strong balance sheet as capital is released from their asset sales, and provisions were down, but the underlying net interest margin fell, down 8 basis points on the last year, to 1.99%, with a fall of 2 basis points in the second half, despite the mortgage book repricing and loan switching. In addition, 90-day mortgage defaults overall remained similar to last year, but with a spike in WA offset by a fall in Victoria and Tasmania. Investment loan delinquencies are rising, as we said earlier, whereas they have traditionally been lower than owner-occupied loans. They've recently tightened underwriting standards, but of course loans already on their books have looser standards. They warn household debt and savings have both increased. However, the ability of a household to withstand economic shocks has diminished a little. In 2018, we expect the revenue growth environment for banking will continue to be constrained as a result of intense competition and the effect of regulation, including a full year of impact of the Australian bank tax. Our own analysis of default probability from our core market model now includes 90-day default risk. We measure mortgage stress on a cash flow basis, and in fact the October data will be out next week, and we also overlay economic data at a postcode level to estimate the 30-day risk of default PD30, but we also now have included 90-day default estimates PD90, and the potential value which might be written off, measured in basis points against the mortgage portfolio. We also calibrate these measures against lender portfolios. Granular analysis can provide a rich understanding of the real risks in the portfolio. Risks, though, are not where you might expect to see them. If we look at the results by state, WA leads the way with the highest measurement, then followed by Victoria and South Australia, and then Queensland. The ACT is the least risky area. In WA, we estimate the 30-day probability of default in the next 12 months is sitting at 2.5%, 90-day default is 0.75%, and the risk of loss is around 4 basis points, which is about twice the current national portfolio loss, which is sitting circa 2 basis points. Banks are cracking down on loans to borrowers buying in Brisbane's oversupplied apartment market, with a number of risky postcodes identified which require bigger deposits. The 4 major banks, that's Westpac, Suncorp, ANZ and National Australia Bank, are restricting lending for certain Brisbane postcodes, where apartment buyers will now be required to have a deposit of up to 20% to qualify for a home loan. Suncorp has blacklisted nearly 40 postcodes in the Queensland capital, including Inner Brisbane, Tenerife, Fortitude Valley, Bowen Hills and Hurston. The banks are refusing to loan more than 80% of the costs of a unit due to, quote, weaknesses in the investment market, as well as the current oversupply in inner city apartments. Prices for apartments in inner Brisbane have dropped to their lowest level in 3 years. QBE's housing outlook published this week suggests that home price growth will slow further in the years ahead. We continue to see appetite from property investors easing as property price growth stalls or in some states reverses. Banks, on the other hand, are chasing new business with deep discounts for new loans. For example, Teachers Mutual cut their rate for new loans by 30 basis points to 3.84%. Westpac, St George, Bank SA and Bank of Melbourne all introduced promotional discount rates, with rates down by 20 basis points or so. Bankwest also offered discounts to both new owner-occupied and investor borrowers. So the war chests created by the backbook repricing earlier in the year, especially investor and interest loans, are being used to target new business. As a result, we expect to see a hike in refinancing, especially in the lower LVR owner-occupied sector, as borrowers seek to reduce their monthly repayments. We also showed that more households seeking a mortgage are generating multiple applications, sometimes direct to a bank and sometimes via mortgage brokers, as they seek to find the best deals. More applications are made via online systems, which makes the process easier, but the net result of all this is that mortgage conversion rates have fallen from around 80% to 50%, creating more noise and costs in the system. We think this is a direct result of the bank's so-called omni-channel approach to distribution, which will turn out to be quite costly. Following the concerns expressed recently by the RBA and ASIC on the risks to household finances, finally we got an admission from APRA that mortgage lending standards have decayed over the last decade and that they needed to take action to reverse the trend, and now they are looking to debt to income. Poor lending standards, they say, are systemic, driven by competition and poor bank practices. They recently intervened, a little late, and late to the piece now, debt to income is important. Did you hear the door slamming after the horse was bolted? The Treasury added their voice this week when John Fraser, Secretary to the Treasury, gave an update on household finances and housing as part of his opening statement to the October 2017 Senate estimates. He expressed the view that debt is borne by those with the greater capacity to repay, but this belies the leverage effect of larger loans in a rising interest rate environment. He said that whilst banks' progress against underwriting measures has been positive, regulators will need to think carefully about whether future efforts to maintain financial stability should lean against cyclical excesses or address structural risks within the financial system. So we have the full Monty, with all four members of the shadowy Council of Financial Regulators expressing concerns about household debt and home price risks. This is a complete change of tune from the declarations of 2015, when everything was said to be just dandy. Now, those following this blog over the past few years will know we've been flagging these concerns, especially as the cash rate was brought to its all-time low. We said debt to income was critical, that standards should be tightened, and the growth of debt to income was unsustainable. All members of the Council of Financial Regulators, which is chaired by the RBA, are culpable. This body, which works behind the scenes, is referred to when hard decisions need to be taken. If you look back at recent APRA and RBA statements, the Council gets a Guernsey. The problem is, there has been groupthink for years, driven by the need to use households as a growth proxy for the failing mining and resource sector, and no clear accountability. But too little has been done too late. And it is the poor old household who one way or another will pick up the pieces, not the banks, who have enjoyed massive profit and balance sheet growth. Even now, lending for housing is growing 3 times faster than incomes or CPI. Regulators are now lining up to call out the problems. Managing the risk going forward is a real challenge. We think it's time to review the regulatory structure and remember the Financial System Inquiry recommended the creation of a new Financial Regulator Assessment Board to assess the performance of the regulatory framework, but this was rejected by the government. That could prove to be a costly mistake. And that's the Property Imperative Weekly to the 28th of October 2017. If you found this useful, do leave a comment below, subscribe to receive future updates, and check back next week for the latest instalment. Many thanks for watching.